We've seen inflation pressures coming down. That's been evident in the data. We might see it again when it comes to the PCE figures tomorrow morning. But when you look at what's happening, say, in the Red Sea, the potential for supply chains to get snarled, for there to be disruptions in energy flows, you consider that we have gone over the child care cliff. We have student loan repayments. All of that may have yet to really fully hit the U.S. economy. Are we out of the woods?
I wouldn't declare victory yet, Kailey. I mean, I think we'll have to wait until the Federal Reserve actually starts to lower interest rates, cut rates. But, it feels like all the trend lines look pretty good here and we're moving in the right direction. Certainly things could derail us. Things like what's going on in the Suez Canal and other geopolitical risks, but they feel more like tail risks, kind of low probability at this point. The most likely scenario is that we're going to make our way through and avoid an economic downturn. So, we're not there yet. I don't want to declare victory just yet, but again, it feels pretty good.
Okay, so say we do avoid the downturn, we get the soft landing that everyone, including the Federal Reserve, is looking for. Why then is the Fed going to start cutting in a couple months? Why not just finish the job if the economy is chugging along, even though interest rates are high?
Well, I don't think they're going to cut interest rates until they feel like they have finished the job. I mean, they don't need to get inflation all the way back down to their target to feel like that's exactly where we're headed. And at current interest rates, that we will get inflation back in the bottle. So if they start cutting rates, then I think they'll feel at that point they're going to feel uber confident that we are going to get inflation back down to something close to that 2% target. I don't expect that until kind of late spring, early summer next year. So we've got a bit of a ways to go here. But again, all the trend lines look pretty good. Inflation's coming in reasonably gracefully. In fact, the only thing that's keeping inflation from its target at this point is the growth in the cost of housing services. But there we know, given the weakness in rents and how that's used to calculate the growth in the cost of housing services, that's going to come in too. So forecasting is intrepid. Some things I feel very confident in, some not so much. But this I feel confident in. Inflation's coming back in.
Okay, so obviously that has implications on the monetary side, but on the fiscal side, Mark, Congress has gone home for the year. They're going to come back in January and very quickly be faced with a deadline of January 19th where part of the U.S. government could shut down. They're going to be dealing with actually top-line spending figures, how much the U.S. government should be spending. How worried are you about the fiscal fight that is ahead?
It's not great. I think it's more problematic in terms of what it augurs for down the road. I mean, we've got an election, coming here in another little less than a year, and I think that could be, problematic. And then on the other side of that, we've got some really hard choices to make that are going to be difficult to do politically. But the potential for a government shutdown at this point early next year, I can't rule that out. It's possible, but I think unlikely. I don't think either party really wants to do that. And I think that's the message in they're kicking the can down down the road twice already. And I think that indicates they really politically know that it's bad politics, particularly in an election year, to shut the government down. So I just don't see that happening. Possible, again, it's a scenario, but I think a scenario with a relatively low probability.
Well, obviously, we see these fights play out on the Hill all the time. The really big fight was over the debt ceiling midway through this year. And at the time, you were out with a warning that if the spending cuts that then Speaker Kevin McCarthy introduced in terms of what they wanted to see, that it would raise unemployment. There would have been hundreds of thousands of jobs lost in the economy as a result of that. What kind of spending cuts could they implement without major detrimental economic effect?
Well, you got to put that into context. Back last summer, the economy looked like it was more fragile. I think recession risks were a lot higher. So I think those kind of spending cuts at that point in time would have done more serious damage and have more likely pushed us into an economic downturn. At this point in time, it feels like the economy is on firmer, more solid ground. It feels like the worst of the recession risks are behind us. And I think the economy can digest, some spending restraint. So the kinds of cuts they're talking about now in order to pass legislation to fund the government and avoid a shutdown, they're modest in the grand scheme of things. And I think not overly aggressive that it would push the economy into recession. It will slow growth, though. So fiscal policy all in will go from being a source of economic growth in 2023 to a bit of a headwind in 2024. And as such, I do think 24 growth is going to be less than 23 in part because of the fiscal restraint. But I don't think it's going to be enough to kind of undermine the economy's growth and push us into recession, at least not at this point.